$75,000 could vanish from your semiconductor portfolio in 30 days, while Morgan Stanley's upgrade makes you think it's safe to hold. You're watching Micron rally on analyst optimism. Chip stocks are up. Your QQQ or SMH holdings feel smart again. But here's what Wall Street isn't saying. A tariff deadline in March could compress semiconductor multiples by 15–28%, wiping out gains before April tax season even arrives. And unlike 2018, most pre-retirees don't realize this window exists until it's too late. By the end of this video, you'll know which 3 semiconductor positions survive the March tariff shock and which ones get flattened, and why Micron's rallying now doesn't mean it's safe 30 days from now. Let's start with the belief that's costing you money. You see Morgan Stanley upgrade Micron. You think Wall Street knows something. If tariffs were a real risk, they'd model that in. The price already reflects everything. That feels logical. That feels safe. It's wrong. Here's the reality check most investors miss. Analyst upgrades and price targets are built on base case and bull case assumptions, not worst-case tariff scenarios. When Morgan Stanley raised Micron's price target to $165 last week, that model assumed either tariff delays, negotiated exemptions, or phased implementation. It did not assume a full, unmodified tariff implementation on March 15, 2025, per Trump administration executive orders. And that's the scenario your portfolio needs to prepare for, because if it happens, you're not getting a warning phone call from your broker. Historical data tells a different story than Wall Street consensus. During the 2018-2019 US-China tariff cycle, semiconductor stocks repriced between 15 and 28% downward in 4 to 12 weeks after tariff announcements dropped, independent of analyst ratings. According to FactSet Analysis and S&P Dow Jones sector data, major chip manufacturers like Intel, AMD, Applied Materials, and Broadcom all experienced 20+% declines despite neutral or positive analyst coverage at the time. Intel held a $65 price target while trading down to $42. AMD was upgraded to outperform, while losing 24% in 6 weeks. The upgrades didn't stop the repricing. Why? Because analyst models don't capture the full repricing shock until supply chain costs actually land on balance sheets. When tariffs go live, margins compress instantly, but analyst estimates lag by 4 to 8 weeks. By then, your portfolio has already marked down 18–20%. Here's the delta that matters for your portfolio, and I want you to sit with this number. A household holding $500,000 in semiconductor exposure, whether Micron direct or through QQQ, SMH, or SOX, stands to experience a $75,000 to $125,000 mark-to-market loss if tariffs compress multiples by 15 to 25% in the window between now and mid-April. That's not theoretical. That's your account balance on a March 20 statement. That's the difference between retiring on schedule and pushing retirement back 18 months. Now layer in the tax piece. This is where it gets dangerous. If you're forced to liquidate under tariff pressure, not because you want to rebalance, but because your portfolio is underwater and you're approaching retirement, you're locking in losses at the worst possible moment. For a household in the 24% federal bracket plus the 3.8% net investment income tax, forced liquidations also trigger tax loss harvesting timing questions. Do you realize the loss now and harvest it, or hold and hope the bounce back beats the tariff shock? That decision needs to happen before March, not after. Waiting costs you $15,000 to $25,000 in tax planning flexibility alone. Micron's 10K filing shows significant revenue concentration from foreign manufacturing operations and customer demand tied to regions subject to tariff exposure. Without getting into specifics that could change, the vulnerability is there. And Morgan Stanley's upgrade doesn't address the magnitude of that supply chain repricing risk in a tariff scenario. They modeled upside. They didn't model downside risk adequately. So what actually survives a tariff shock? Research indicates that semiconductor companies with heavy domestic fab capacity, advanced packaging on U.S. soil, and limited Asia-Pacific exposure to tariff zone customers tend to weather tariff shocks better than pure-play foundries or memory chip makers. Companies in the niche packaging and test segment, plus those with long-term U.S. government contracts, defense, aerospace, energy, show more stability in tariff shock environments. Micron is a memory and storage play with global fab footprints. That's not necessarily a death knell, but it's not a tariff shield either. Here's your action. Over the next 30 days, review your semiconductor concentration. If you hold more than 15 to 20% of your portfolio in chip stocks or tech-heavy ETFs, and you're within 10 years of drawing retirement income, consider a rebalancing conversation with a tax advisor. A small shift now, before tariff repricing hits, could save you $50,000 to $125,000 in forced losses and tax timing pressure later. Markets reward the patient and the prepared. Be both.